as promised, we have Ritu Arora, Chief Investment Officer of Canara HSBC OBC Life Insurance Corporation. Thank you so much for joining us, ma'am. Insurance monies are slightly different from a standard mutual fund because you have I'm assuming, a much longer period in mind. So how does the investment philosophy change? What do you look at when you invest?
Sure, definitely we have long-term horizons. We have recurring flows into the funds, and our money is managed more on a fundamental approach. We at Canara HSBC, Oriental Bank of Commerce Life Insurance, have a very structured approach, a very disciplined approach. We do not take very big cash calls because we believe our policyholders have bought our policies because they want to be invested in the markets. So we do a bottom-up analysis for stocks pickup, while we do a top-down analysis to identify the right sectors, and have created very consistent wealth for our policyholders over the years with this very disciplined approach.
So let me start off with the top-down analysis that you do. Right now, what sectors are you finding attractive?
We are, as an economy, we believe that domestic economy is what is showing the strength. Global economies are still struggling with the revival of growth being a key challenge. There is lack of arsenal that are available with central banks globally, and we will continue to see headwinds that we will import from European markets, from US markets, with fears looming large on Fed, when it increase rates. So globally there will be a fair bit of turmoil. Our economy has been showing a fair bit of strength in terms of macroeconomic fundamentals. It hasn't looked better for India in a very long time, and that's across the board, be it our inflation numbers, be the reserves that the country has, the strength that the currency has demonstrated. The GDP numbers have been robust when you compare them with the rest of the world. Interest rates have been coming off. So macroeconomics is falling into place after a very long time in a very consistent manner. What is important here is to have the right stock selection. So as a top-down analysis that you asked, in terms of sectors, I like all those sectors which will benefit from domestic recovery, which will see the demand coming back and have improvement in their balance sheets and revenues. So I like sectors like automobiles, I like a sector like infrastructure, cap goods, cement. So all banks, NBFCs, all sectors that benefit from Indian economy.
So that's interesting that you're saying that you like capital goods, for instance. Most people say that the capital goods revival cycle is still about 2-3 years away. But are you saying that it's pretty cheap right now and therefore you're getting it at a bargain?
It's always very difficult to catch these cyclicals at the right time. So yes, I would like to start building a portfolio of the strong capital good companies, which is then selected through the bottom-up analysis, and it needs to be very rigorous. You cannot have a secular investment in the sector. The variations are very sharp between different companies. But yes, we do believe it's time to start building a position there.
Okay, when I look at the portfolio of some of the funds that are managed by you or by the company, then there seems to be a somewhat conservative approach, right? Where a lot of exposure to big cap, known names. There is a significant amount of exposure to banks, some of the big cap auto, big cap pharma. Is this an overall principle that you follow to ensure that capital is protected?
My view is divergent from yours. We have delivered across 8 years consistent outperformance over benchmark across all our funds, and a very significant outperformance. And we stack very high in peer performance vis-a-vis our peers. We have been quartile 1 performers consistently. So the approach is not conservative at all. It is very actively managed portfolio. Okay. And depending on the economic environment, the sectors as well as stocks are selected, as I said, with rigorous sectoral as well as stock analysis. So we do at this point in time, as I mentioned, have a preference for banking, NBFC, auto stocks, cement. All these have played out very well for us. We do have a good exposure of mid and small cap, where we have high conviction. And in fact, we are just looking at even launching more funds which have larger mid and small cap exposure. So I don't think there is any aversion or preference for a particular capitalization. It depends more on the fundamentals of sectors and stocks.
But when I go to the site and I look at the portfolio breakup, and perhaps I'm looking at the wrong funds, but if I look at, let's say, your unit-linked growth fund, unit-linked growth 2 fund series, and one looks at the portfolio as of September, the biggest exposure is still in the big cap space. I can see Maruti, HDFC. I know you can't talk about the individual stocks, but I'm just reading out that the top 10 equity stocks are Maruti, HDFC Bank, Sun Pharma, Yes Bank, Infosys, Kotak Mahindra Bank, IndusInd Bank, L&T, ITC, which make up about 55% of your portfolio. Now, I know maybe the details are in that remaining 45%.
That reflects exactly what I told you.
Yeah. I guess the details are in the remaining 45%. I'm saying that...
these are all stocks which will benefit from the domestic sector recovery and reflect the sectors that I just highlighted for you.
Right.
Of course, there is a very large many more shares than the 10 that you counted that we have, and we have a good representation of different market caps.
All right, but you know, you did say that you have consistently outperformed the benchmark indices, and that's obviously in the way in which you've distributed, even if it is similar to the index, the way in which you've distributed the proportion that you put in various counters. Would it be fair to say that in the Indian context, if one sticks to known stocks, which are there in the index, but then...
I would like to correct you there.
Right.
The distribution is not aligned with index at all, and
no,
that
that's
would
what I said,
mislead
I
the
said that
investors
obviously,
and people watching the show. So
that's what I said. That I said obviously the distribution is different from the index, and that is how you generate the returns. I mean, you're taking a call on the distribution. I'm just looking at the profile of the stocks. Would it be fair to say that in the Indian context, people will make decent money if they stick to the stocks which are already in the indices?
And the stocks that are in indices do reflect a significant part of the portfolio. If you look at Nifty 50, the 50 stocks that comprise it also constitute a significant portion of the Nifty 100. The Nifty, the next 50 stocks have a smaller proportion. So that does happen. But also one has to be conscious of the fact that these are companies that are already recognized, well researched, and find place in different institutional and large portfolios, and that's why they make it to the index. Right. It is also important to identify the next companies which will make it big and make it to the index. And wealth is created by making the right stock selection across both these universes.
So when you have this, big insurance monies to deal with, I'm assuming that even when you decide to put in, let's say, 0.25 or 0.5% of your corpus in a particular company, that's a lot of money, right? So does that kind of put a little bit of constraint on the market cap size of the company that you can choose?
We have different portfolios. It's not one pool of money. So we have different pools. You talked about growth fund, which is one of the fund series we have. We have equity fund, we have balance funds, we have guaranteed funds. So we have different funds and the different fund managers, sometimes different strategies as well. And hence it is possible to make investments. If I try to invest half of 1% of the entire corpus, it could be a limitation, but the stock may not fit into the strategy of all the funds. Right. So while very small market caps can be challenging, most other times we do manage to invest.
All right. Let me come now again back to individual individual sectors. I had asked you about capital goods. You have said in the past that consumption is one of the things that you are looking at closely. Now, within consumption...
I've lost audio.
All right, we'll just try and link back to you. Ritu Arora appears to have lost the audio there, so we'll try and fix that. We'll come back to her in just a couple of minutes. We're taking a short break. We'll be back. Welcome back. We're speaking to Ritu Arora. She's Chief Investment Officer of Canara, HSBC and Oriental Bank of Commerce Life Insurance Company. Ma'am, right before this break, I was asking you about the fact that you have been bullish about consumption recovery discretionary consumption recovery. But before I go into that, I just want to talk about FMCG. Now, I'm sure you've also seen the earnings call of the parent company of Hindustan Unilever, where they've said that market conditions in India are softening and rural demand is actually not picking up. Input costs have gone up, and we've tried to pass it on to consumers, and that's led to volume decline. That seems to paint a slightly different picture from what we've been hearing, or what we've been hearing from a lot of big investors about rural economy and rural consumption.
It will be very interesting to see how the rural economy comes back. After a couple of years, we've had a good monsoon. And the thought that's emerging, it may take a little while before the spending comes back, because deleveraging is the first action that seems to be happening out there in the rural economy. It is very important to watch out for the consumption recovery trends, because that will really give the confidence and set the tone for an upswing that we should see in the market. So earnings returning and consumption returning are key trends that we need to watch out for, and the importance can't be diluted.
What are your channel checks showing in terms of monsoon leading to higher spending?
Like I said, it seems to be the initial reaction of the farmers and the rural economy seems to be to deleverage. They've been fairly leveraged because of couple of bad years that they have seen in terms of monsoon. And I believe the next leg is where we'll start seeing the consumption.
But in terms of urban consumption, what is your sense?
I would believe the triggers are all there with Arora payments, the pay commission payments, the money, the disposable income is being placed in the hands. And if the confidence is there in the economy and recovery, you will see spending. If that is lacking, in that case, you will see more of savings. I would like to bet on the former, and I like to believe that as the macroeconomic fundamentals are falling into place, people will have more confidence to spend, to go for their discretionary spends, be it holidays, be it picking up white goods. So it will be very interesting to watch these trends, and that's how I hope it will play out.
Well, as you did mention that you're betting quite a bit on financials, right? When it comes to financials, which side would you be on, private or PSU space?
Banking is a reflection of the economy, other side of the coin, as I often refer to it. And if I believe that the economy is improving, the macroeconomic fundamentals are looking good, banking will reflect that. Of course, we've had a very my preference has been for private sector banks. Public sector banks did give a pop-up for a while, but there are still problems to be sorted out, and it is good to see big accounts being addressed now. But I think there's some journey yet to be covered. Till such time, I'm quite excited about the NBFC space. We've seen good run-up in housing finance companies as well, and private sector banks. I would take public sector banks in the portfolio with a lot of analysis and not as a very big overweight.
How important are deals like SR Oil for the health of Indian banks?
Needless to say, all stressed assets, any stressed asset, significant stressed asset, non-performing asset problem being sought out, brings a lot of confidence, and it is very positive for the banking sector and economy as a large.
Do you see real estate sector coming back into play, not only because of the fact that houses will sell, but there are companies which have been at lows, they have come up. I know you can't talk stocks, but many of them are getting deleveraged. Many of them are now looking to rental incomes, REITs. Would you buy real estate stocks?
I would be wary of the sector for the management quality, the governance quality, etc., and the stress that they continue to witness in terms of very large inventories, demand still being tepid. So real estate is not a sector I'd be bullish on.
All right. one final question, ma'am. In terms of capital goods, you said that you are going to start picking up capital goods because you think that probably they've bottomed out. But short cycle capital goods, things which have a faster replacement, are those the ones which you're going to look at first?
As I said, within the sector there is huge disparities and very wide variations between the companies, and I would caution that one should only do it with a very focused stock selection, and hence I wouldn't want to trivialize it by putting it around a short cycle or long cycle. One needs to only buy into strong fundamental companies here, otherwise it's still, like you rightly pointed out, there could be quarters of pain ahead.
Okay. I know I said one final question, but since you're saying that it has to be bottom up once one has identified the sectors, what are, for our viewers, give us a few indicators that one should look at, few metrics that one should look at when one does the bottom up picking.
Sure. So one needs to look at the stability and consistency of revenue growth and profitability growth over the last few quarters, needless to say. I also give a fair bit of importance to the management quality of the company. It is very important to have the right management to stage a recovery or to stage a robust growth. Besides that, strong brands with good franchisees and cash flows are pretty important to me. Cash is a king in this kind of a turbulence, and companies which have a good working capital cycle, cash flow cycles, have sufficient cash in their balance sheets should be preferred.
All right, ma'am, thank you so much for joining us and taking time out for us. Pleasure talking to you.